Well, happy Thursday, everybody. We had nice ice storm last night, so it was really fun getting into work this morning over here in Chicago. I do want to mention my colleague Neil is on the call. Neil's going to help provide a little bit of an update today for the committee. Neil has been with Wespath since 2021. Did I get that right? 2022,
2022,
2021.
yeah, 3 full years. Yep.
3 full years. And Neil actually has a very similar background as myself. So we poached him from the Northern Trust Company, where he worked in investment performance and investment risk. So Neil's been working a lot behind the scenes on this relationship. So helping Dustin and Gloria with some of their reporting, quarterly and monthly reporting to their clients. Sometimes Dustin gets questionnaires from clients and Neil helps me complete those as well. So wanted to start getting Neil a little bit more involved on the front end of the relationship, since he's so well aware of kind of everything that happens on the back end. So Neil's going to participate in the meeting and give an update on your accounts. And then we'll turn it over to Frank, and Frank will provide an update on the markets. And then I'll sort of end, and Frank and I will end the presentation and talk about the contributors and detractors of the fund performance. So kicking off, we always like to talk about any publications or blogs that we publish since the last time that we met. We've been doing a quarterly investor letter that we've been publishing. There's the QR code on the screen if no one's receiving those. I think most of you should be receiving those in the weekly emails. If you're not getting our weekly emails, please let Dustin or Gloria know, and they can make sure that you get added to that as well. We talked about the last few meetings, and I need to move the audio thing. It was in my on top, right in the middle of my slide. We've had some fund updates, and you've heard Frank and I and Raj talk a little bit about that work that's being done. We did complete, we're doing deep dives primarily on our equity funds, and we completed those deep dives on our social values choice equity fund and bond fund. You've probably never heard of us really talk about this fund. This is a fund that was primarily available to participants on the retirement side, pension side, but we launched these funds now on the institutional side. These are funds that have heightened exclusions as it relates to human rights and also fossil fuels. So there is a large constituency in the church that prefers an investment of this type. So we launched some institutional iShares iSeries funds with this type of exclusion in them. We do continue to review the U.S. Equity Fund and International Equity Fund. But we've completed 45 due diligence meetings with current managers. So again, having our managers come in, we went to them also and met with them to talk about objectives of their account, strategy, things of that nature. We also completed 50 due diligence meetings with prospective managers. So again, really trying to make sure we have that deep bench of managers. If we are looking for a replacement or an addition, you'll want to make sure that we have a good, really a good mix of managers that we can tap into should that time happen. We've also done fee negotiations with our strategies. One big thing that Jahara, our new chief investment officer, when she started, just kind of really hit the ground running and working with our investment managers on the fees that we were paying them. So we did negotiate fees with, I think, over 10 of our strategies that we have that are part of our funds. We did have some asset manager updates. We replaced a manager in our social values choice equity fund. This manager, when it was primarily on the pension retirement side, was the Northern Trust Company, and we replaced it with a diverse woman-owned investment firm located in Raleigh, and they're called Exponents. So we did replace the manager in that strategy, and then we also terminated a manager in our international equity fund as well. Frank, is there anything that you would add?
Just a reminder, I think we had mentioned in our previous meeting that we had hired a woman named Hua Kwok in the middle of 2024, and she's in the role of Director of Public Market Investments. And so she is really driving those due diligence meetings with the prospective asset managers. And that's one of the areas where we feel we can add value is by identifying asset management firms with unique skill sets. And so she brings almost 20 years of experience with Mercer Consulting doing the very same sort of work. And so I'm just so thrilled to have her on board. And if you haven't met her yet, we'll have that opportunity for you in the future.
Yeah, Dustin, I actually have her tagged to come with me for our next in-person visit this summer. So
Oh,
while we'll be joining us, and we figured it would be a good time for her to really dive into the work that she's been doing um, at that time. So yeah, the plans for her to come at the second quarter meeting. I guess that would be okay. If any questions before I turn it over to Neil to provide an update on your accounts. Okay, Neil, over to you. Just let me know when to switch slides.
yep. Take a few minutes here to talk about your investment accounts before kicking it over to markets. But you can see we closed the year at 73.4 million at the aggregate level. And the lion's share allocated to the balance fund at about 69% of the aggregate. Now, a lot of what we're going to talk to today in the presentation is through a lens of a year end or even a quarter four 2024 view. Did want to give a little preview since January just closed a few days ago. So if we were looking at January, you would see an aggregate balance of 75.7 million. So that's a nice capital appreciation of about 1.7 million for the month of January. Next slide, please, Karen. All right, the balanced fund here returned negative 1.6% for the quarter and a positive 8.8% for the 1 year. On an absolute return basis, obviously an 8.8% return is a really healthy, strong return. What we don't like to see is the negative relative return of about 1.8% under benchmark. But I did want, and some of the drivers there. So if you're wondering, all right, 1.8% under benchmark for the 1 year, what drove that? It was largely the equity fund, the US equity fund, and the international equity fund. On the US equity side is really the similar story to what you've been hearing throughout the year, I'm sure, from Karen and Frank. It's our strategic biases in that fund. It's active management impact. And on the international side, it's mostly asset manager impact and some of the stock picking that has led to performance under benchmark. But also here, before moving on, I wanted to make sure, I know, Dustin, you're really familiar. We've talked about this probably half a dozen times about the allocation changes in the balanced fund, but I want to make sure everyone on the call knows that as of October 1st, 2024, the allocation switched from 100% multiple asset fund into a new allocation of 35% fixed income fund, 20% international equity fund, 25% US equity fund, the active fund, and 20% US equity index fund, so the passive counterpart there. And really what's happening here is from the old to the new allocation, we're taking 10% from international equities and allocating that to US equities with a split between active and passive. And the second thing that's happening is the IPF, so that inflation protection component, is being removed here, and the entire 35% fixed income portion is now the fixed income fund. So I just want to make sure that everyone was aware of that, because the performance you're seeing there, if you look at a 1 year performance of 8.8%, that is a mixed bag. You have 9 months of the old allocation and 3 months of the new allocation. Any questions there, or does that align with your expectations?
Oh, just curious on I realize it's very short term, but how did the old fund we were in for the fourth quarter do?
Yeah, Karen, were you?
I'm gonna pull it up.
Sure. Make sure we're.
Yeah, so it's the multiple asset fund in the fourth quarter. The multiple asset fund returned 3 months down. It was about the same, 2.8.
Okay.
Down 2.87. Yep.
All right, thanks.
Okay, was that for the quarter or for the
Quarter.
down 2.8 cent? Okay. And so the balance fund was down
Yeah, it
for the
says
quarter,
quarter.
1.6% for the quarter here for the balance fund.
Yes.
Oh yeah,
our
so you
team
did, so
better-
you did
We did
better.
better. Yes.
You did better.
It may
I
not
was
have been
looking
better
at
in
this.
January, but it did do better in the final quarter of 24.
Yep, you're right. Thank
Yes,
you
that
for correcting me. I was looking at the first number. So thank
three
you.
mo 3 months of an allocation to those passive US equities, that'll do the trick and bump it up ahead of the multiple asset fund. All right, Karen, you want to move on to the fixed income fund? So no changes here, no allocation changes here throughout the year. Quarter to date return negative 2.6% in line with benchmark. The 1 year a positive 2.7%, about 40 basis points above benchmark. Let's go on to Karen, to the next slide with the Kansas Equity Fund. So we did have allocation changes here as well, similar to the balanced fund. But this in aggregate returned negative 1% for the quarter and a positive 13.9% for the 1 year. Again, on its surface, a nice absolute return there. What we don't like to see is that negative excess versus benchmark. Same drivers here as we mentioned for the balance fund. We're looking at the US equity fund, the active fund, and the international equity fund as the culprits there, as detractors from relative performance. But the allocation changes here, again, just to make sure everyone's on the same page. Same effective date, so October 1st of 2024. This allocation moved from 65% US equities, 35% international equities. And what it did was it took 5% from the international equities and moved into active US equity. And then, so that ultimately there was a 10 and then 10% to passive US equities. So it started with a 65-35 US equity, US international split, ended with a 70-30 split with a little more going to passive US equities.
Yeah, and if you remember when we set up this account, when you hired us in 2019, the end of 2019, it was 45% international and 55% US equity funds. So we've over the years have gradually made changes, lowering international, bringing in the index fund to look more market-like, which lowered the fees altogether because international is higher fees than US just because of the nature of the asset class. So we have made like changes throughout this fund since you hired us for it. And so now you're 70% equities, 30% or 70 US, 30% international, which is, I would say, in line with what our other foundation partners offer. When they have a global equity portfolio, it's mainly 70-30 or 80-20 is what they look at between US and non-US.
Yeah, we've gradually seen that increase over the years in that US equity exposure, and that's captured in the benchmark as well. All right, well, the Kansas Equity Index Fund, about a little shy of 2 million allocated here as of year end. Well, this is where everyone's wanted to be. This is, you can see that 1 year return of about 24%. The story all year has been the concentrated US equity market and how active managers are having a really hard time outperforming the benchmark there due to things like concentration limits and not having the ability or the desire to concentrate so much in those top names. So this is where, I'm excited to see this allocation to the index fund here, as in some of the other Kansas funds. And then the short-term fund closed the year at about 4.4 million. Quarter to date returned 1.1%. The 1 year positive 5.2%. I mean, if we take a moment to think about that 1 year return for a cash-like vehicle, that is an outstanding return. Obviously, very, very low risk in this fund, the lowest risk fund that we offer. Returned 5.2% for the 1 year. That's phenomenal. I just took a look, and the most up-to-date yield to worst for the short-term investment fund is 4.5%. So, oh, Karen, I see your screen hopping around a little bit. Oh, you're on mute too. Nope, still on mute, Karen. But if you flip back to the presentation, right now we see your desktop. There we go. Okay,
I'm
so
a
we're
hot
back.
mess today with Neil. It's all
No,
going all over the place. But I was trying to pull up the yield to worst on this that we got on our short-term fund. So the yield to worst as of last Friday
yep,
is 4.5%.
yep, that's where, yep. So that's still a really strong yield to worst. Obviously, we expect that to change as interest rates change, but we'll see. Maybe not as much as previously expected in 2024. You know, the Fed is going to be very data dependent before lowering rates, but as rates lower, we would expect the yield to worst to also move lower for the short-term investment fund. But as of right now, 2024 was a wonderful place to be invested and even outperformed international equities in 2024.
How are the other because the short-term fund is just one part of your short-term investment vehicle. You know, how are the other, because there's CDs and other things in there. I mean, how, you know, what is the return on those investments that are part of it as well?
They're not as strong
Okay.
in comparison, which is you know, part of why we've moved more and more to this account. Um, However, they will endure more. So if rates go down, those others will last a little bit longer
Yeah.
at the current rates. So it's kind of a hybrid. But the bulk of the money, 68% of the money is in your fund of the
Okay.
total amount of money. We have others in U.S. Treasuries and bank CDs. So most of it is with your account.
Okay. What's the average duration of the CDs that is it 12 months or?
I don't know that answer. I
Okay.
know overall it's 2.4 duration months. Counting yours is
Okay.
0.
Okay.
Yeah, so
Got it.
we're weighted largely on very short term.
Okay. Thanks for that update.
All right, Karen, did you want me to speak to this as well, the financial reconciliations? All right, well, this is a snapshot in time that I like showing to clients. We're looking at a quarter to date snapshot. I love looking at the aggregate level, so that top line, the total fund, to see where you started and where you ended the quarter. You could see there was that negative, there's that depreciation of about 1 million during the quarter. Quarter four was tricky. There was a ping pong effect where markets were down in October, up in November, back down in December. It's kind of we expected headwinds and some market volatility leading into the elections. That's exactly what we saw in October. November, there were some tailwinds. There was some positive momentum from some of the Trump policies that were being discussed. And then December uh, turned mostly to the theme of inflation being a little stickier, some of the momentum wore off, so December was down. So about 1 million in capital depreciation for the quarter. And Karen, if you could go to the next slide, I think we have capital appreciation, more like what we want to see here at about 6 million positive capital appreciation for the year. Here you can see the allocation changes that happened as well. So you can see from the Kansas Balance Fund, you see the 48.5 million coming out of the multiple asset fund and being allocated to those 4 underlying funds right below the multiple asset fund. So it's a nice snapshot here. I hope this is a useful tool for all of you.
Yeah, thanks, Neil, for that. I was just going to point that out. You're probably like, oh, wait, you got 60 million and then you took 60 million out. But yeah, this is the contributions and withdrawals is the rebalance out of the old allocation into the new one. So thank you, Neil, for highlighting that because it can be a little confusing. Any questions before we turn it over to Frank? Okay, Frank, over to you. Just let me know when you want me to turn. And then Dustin, I do want to highlight we did add the Russell 3 and the 2 indexes that you requested. So I did want to point that out for you before we
Thank
turn it over to Frank.
Sure. Thanks, Karen. We'll look at equity markets first, and we've got various segments of equity markets listed here in the rows, and then we've got them sorted by their year-to-date return in that very right-hand column, and then quarter-to-date next to that. And I guess I would note that when I look at the full year, it's all positive. Even the weakest of the equity markets returned a reasonable positive number. Even emerging markets, which have been relatively weak in recent years, a positive return there of a little over 7% near the bottom of the page. But what's really dramatic is toward the top of the page when you look at what we're calling here the mega cap return. This is the Magnificent Seven companies that we talked about for most of the year. The companies that are enjoying the enthusiasm around artificial intelligence and technology. Now, since this time in the month of January and early February, it's been a very different story. I think largely triggered by the DeepSeek news, the relatively small firm in China that really surprised the world with the efficacy of its artificial intelligence capabilities with apparently a relatively lower cost. And so while the Magnificent Seven had an extremely strong 2024, 2025 has been a little bit more rocky. The star of that Magnificent Seven show, NVIDIA, that makes the computer graphics chips, was down 17% in one day on the news of DeepSeek. And I think now year to date, it's maybe down 10% or so. But those super large technology companies represent such a large weight in some of these other indices that they really drove that performance. And we've got a little bit more on that in a couple of slides here. And the next slide is showing the price level on the S&P 500 index, large U.S. companies through time, and then in the table there are a few different interesting metrics, not only about the index level for the S&P 500, but also the estimated forward price to earnings ratio and the dividend yield, and then for comparison, the yield on the 10-year Treasury. And we show those at different points in time. This is a slide from JP Morgan. And I think what they've called out, some of those earlier dates were inflection points where the S&P 500 peaked and then started a downward trend. And this isn't saying that the end of 2024 was a peak. It's just the most recent data at the time of this chart. And I think it's interesting when I look at the PE ratio in that table for the S&P 500 of 21.5, that's definitely on the high side. But when I think of the inverse of that, the earnings yield on the S&P 500, it's just about the same as that 10-year Treasury yield. We're seeing a couple of rows beneath it. And so, with the increase in bond yields and with the rising price to earnings ratio on stocks, just the relative yield of those two asset classes has shifted towards bond. Now it's pretty much equal. And then on the next slide, we're showing that on that left-hand chart is the price to earnings ratio in green of the top 10 companies in the S&P 500. And then the lightish blue is the rest of the S&P 500. And so you can see how those top 10 stocks appear much more expensive. Now, part of that, of course, is driven by the really strong earnings growth, gives investors optimism that that growth will continue. And yet, when you look at that top right chart, that's the weight of the top 10 stocks within the S&P 500 index. And that has really shot up quite a bit. We're seeing almost 40% as of the end of December. And we haven't seen that kind of concentration in the S&P 500, I think since really the dot-com euphoria. Now looking at performance, that was the price to earnings ratio. Now looking at performance on the left-hand side, the Magnificent Seven in over this time period is in the green line, and likewise the rest of the S&P 500 in that light blue. And on the right-hand side, we show some information from JP Morgan about the earnings. That top chart is showing that the Magnificent Seven earnings compared to the rest of the market had been extremely strong, and that explains probably why those stocks have done so well. But it seems that that gap is closing, and analysts expect it to close further, and part of that is because of the profit margins that we're showing on the bottom there, where it appears that perhaps the Magnificent Seven profit margins have sort of plateaued, where the rest of the market is rising a little bit. And then finally, just a reminder, we pull this slide out often during down market years because we just want to, and this certainly was not one, but we just want to remind investors, if you look at those gray bars, that's the full year return, year by year, for the S&P 500 index. And in years where the return turned out to be a really strong positive number, you still see those little red dots where that was the maximum drawdown during some part in that year. And so it's just a reminder to investors that we'll experience significant drawdowns in markets, and it really takes some discipline to stick with your long-term plan. And that's how you achieve those really strong annual numbers that we're showing on the chart here. A little bit more about global, comparing the US to the rest of the world. If you look at that top right-hand chart, we've been talking a little bit about concentration within the US. Now this is concentration globally, and we're just looking at the US share of the global stock market capitalization. That's in that dark blackish line at the top. And we see it's been steadily rising. Through time it rises and falls, but really since after the global financial crisis, it's been really steadily rising, so that the US stock market really represents a little over 2/3 of the global stock market. And then on this chart, on the right-hand side, I think we've shared this in the past, when you think about the price that an investor is paying for $1 of earnings within a company in these different geographical regions, US, Japan, the rest of the world, those gray bars represent what was the range for price to earnings ratios over the past 25 years. And in the little light blue diamond, we're seeing that's where it is now. And then that purplish little line is the average over the 25 years. And so when you look at the US, the current price to earnings ratio is near the top of the range and well above the 25-year average. And we've talked about how, artificial intelligence has created a lot of enthusiasm and strong earnings. And yet, the rest of the world looks generally below the longer term price to earnings ratios. And now this isn't to forecast what's going to happen next, but it's just a reminder. I think you're prudent to maintain a degree of diversification into non-US stocks, as you've done. And then this one was a surprise. One of our team members shared this with our weekly investments meeting. This is looking at the time period representing this most recent bull market, which started in October of 2022. And it's saying, okay, the S&P 500 has really been supported by companies like NVIDIA. What if NVIDIA was not in the S&P 500? That's what that light blue line represents. That's the cumulative performance of the S&P 500 without NVIDIA. And this is going through a date in December when this firm ran the analysis. And then that green line is the Eurozone, basically the European Monetary Union. I was so surprised when I saw this because I would not have expected to see that it was basically the same return that an investor would have gotten from investing in Europe as they would have in the S&P 500 minus NVIDIA. It struck me how impactful the very largest companies in the S&P 500 have been to those returns, and also just reminded me that there are other areas of the market that have actually done okay. We'll
Before you
talk
go
about,
on,
yeah, go
Frank,
ahead,
I
Karen.
just wanted to pause to see if there's any questions about the equity markets before we dive into the fixed income. And, Dustin, too, I wanted to, if there's any questions that you're getting from investors regarding the equity markets, international markets, before we kind of switch gears and talk about the fixed income markets.
I just find that more of our investors who work with us and want to look into the details usually have an aversion to international equities, and so we've used that U.S. equity index to reduce that international to meet their appetite. And I will show these slides, and they still see that NVIDIA's performing really well, and the U.S. is performing at a high level. I'm curious how the content that we're hearing here about markets, how that impacts, Wespath's long-term strategic initiatives, or if it does, if there are more seasonal biases that pop up or not.
Yeah, and Dustin, I would say that we don't think of ourselves as tactical investors. We really seek to be long-term strategic. And yet, Kieran was describing earlier at the beginning how we go through what we call deep dives on our funds, where we really evaluate the way our funds are positioned. And so, one of the impacts that we've seen on our funds because of these market conditions is in our US equity fund, where we have maintained a more diversified posture than the benchmark, we own those Magnificent Seven companies, but just at a lower weight, and then spread the rest, into some smaller companies. That's been a detractor in recent years. And, we observe that there has been a relatively clear cycle over the decades of the smaller companies having a period of significant underperformance and then significant outperformance. And so we're in the process now of performing those deep dives where we're reevaluating, is the strategic positioning optimal within our U.S. equity fund. Likewise, in our multiple asset fund, we've talked about the U.S. versus international. And there too, we see these long cycles of the U.S. outperforming non-U.S. and then vice versa. It's clearly been a period where the U.S. has strongly outperformed non-U.S. And as you recall, our multiple asset fund weights international relatively high versus some other market indices. And so there too, that's been a detractor for our multiple asset funds being more diversified geographically. But there too, we're in the process of conducting the deep dive to evaluate what we really believe would be the optimal weight between, for example, U.S. and non-U.S. And so, I often find that when you're looking at optimizing an asset allocation, you'll arrive at a range of reasonable diversification. And within that range, it's really up to investor preference, I think, what investors are comfortable with. And so we just maybe you'd say we do like to meet investors where they are. We want to give investors the option to express their own views while also providing the guidance and the research to help them make those decisions.
I think also too, as Frank mentioned, we are very strategic, so we like to maintain our our allocations to each of the asset classes and so forth. But we do rely on our managers in terms of stock selection of where they see the opportunity for their strategy to outperform on the active manager side. So, and that's part of that deep dive work, is making sure that we have conviction in those managers, that we are relying on picking the winners and not the losers over the long term in the portfolio. Because at the end of the day, we view them as having the expertise of knowing these companies and these markets, better than Frank or I or Neil in that capacity.
Yeah, both of those things are helpful. Thank you. I was thinking of scenarios where, Fed raises rates, and in such conditions, we pull back on our overweighting to small and mid cap, for example, at a certain degree over a period of time, and then move back. Or just a hypothesis, not research, but trying to think of how that plays into your work with the asset allocation.
Yeah, we don't make the changes in terms of like if the Fed does that. What I can say though is on the fixed income side, that fund is 100% actively managed. So we may see PIMCO and some of the other managers go in and out of areas of the yield curve based on what they think the Fed's going to do or how that's going to be impacted by the Fed, or maybe diversify outside of the yield treasuries and so forth. But it does impact what the companies our managers are buying and issues on the fixed income side. But at Wespath, Frank, it's not like an alarm goes off and then everyone's like, sell small cap, and then, we all scramble for it. But it is very strategic of how we look at it. And as Frank mentioned, we're really going through how we are strategically investing and the degree to maybe which we are overweight small and mid relative to the large names. So we'll make sure to keep you posted. As Frank mentioned, there's been no major changes in the fund as of yet, other than just, we did terminate a manager in our international equity fund, so forth. So Frank, I'll turn over to you to maybe give an update on the fixed income markets.
Could I ask one question?
Yeah. Oh, please, Sean.
And it is more of a strategy-based question. How you guys see things. Have you considered, or do you consider as part of your strategy, the shift in investor profiles as it relates to what we've seen this century so far, the weighting of allocations to passive versus active? I know you talked a little bit about what Frank did about the weighting of the Magnificent Seven inside the S&P 500 and how those stocks actually drive value, and the thought essentially being around, if things continue to be okay in the markets, how those major weights continue to drive the majority of the value inside markets. I also would kind of say I think that the thought as to what we're doing from a diversification standpoint and still maintaining some exposure based on some of those slides that you had shown, that the potential for reversion is going to be there at some point in time. The double-edged sword that is the Magnificent Seven, from a weighting standpoint. But just really the question was just, do you have consideration as it relates to the rise of passive? Because I think the numbers were essentially around 2000, like 2% of the weighting of the of all investors were in passive, and now it's it's approaching, if not at 50% overall. So just was curious if you consider passive at all as it relates to how you're picking and choosing your investment strategy.
Yeah, it's been interesting to watch, hasn't it, Sean? The shift toward indexing, and I'm not saying we are against passive investing, because even within our U.S. equity fund, we do obtain passive exposure for a big portion of that fund. Almost half of that fund is in passive strategies, more toward the large cap side, where I think it's a bit more difficult for active managers to outperform the index. I do have to ask myself, though, and we as an investment committee ask ourselves, how much of the rise of indexing is sort of a self-fulfilling prophecy, where the success of index funds drives more people into those funds, which is putting more capital into those largest companies, which is driving the price higher in index funds. And, eventually, even if that's happening, the earnings realities will catch up, and there will be a period where those largest companies, if they can't maintain the level of growth that the market metrics are implying, I mean, they'll have to come back down to earth. And so it's not to say that we think, oh, indexing is bad. It's just investors chasing performance, because we do rely on passive in some of those larger market segments, the larger cap areas. But if you took it to the extreme, if there were no active investors, well, then who would be determining the proper price on these companies? And so I see by your reaction that these same things have been running through your mind, and I think they have been for many active investors. Active investors have had a really difficult time, as Karen said, versus these concentrated benchmark indices. Um, but market cycle,
I mean, it was like 80% of active managers underperformed last year. And it's like, we hate that we're part of the 80%. We want to be the outlier. But it's been just a really tough place for active management. I mean, I listened to JP Morgan, their quarterly webcast that they have. And I mean, he's such a proponent for active management, especially in these market cycles of, new administration coming in, not really sure how some of his policies are going to be impacting the market. We would think it would impact one way, but we find out it's impacting in another way, and so forth. So what we've been seeing on the client side is something very similar to what you all have been doing, is you're mixing active and passive and kind of being a little overweight on the passive side. And decreasing the international side. I mean, that's what we've been having a lot of conversations with our clients as it relates to active versus passive, because it has been a very challenging active management environment. And like Frank mentioned, we carry a little bit of both in our U.S. equity fund.
We had some strategists from BlackRock who were in our office visiting with us a couple of weeks ago, and they were sharing some charts somewhat like we're sharing with you now, and just saying, the S&P 500 is really not a diversified equity index anymore. It's really concentrated in technology. And when you think about your risk posture, you've got to think about not only, how have these stocks returned and what do you think their earnings are going to look like going forward, but also what's the risk if something goes wrong? How concentrated of a commitment are you making?
Neil, did you have anything to add? I saw you went off mute.
I appreciate that explanation, Frank. I really do. I think that, and Karen, you're right. I mean, it's all of us that are in the active space or have been having these types of dilemmas ourselves. And, it's what Frank was essentially talking about is, the inelastic market hypothesis. If it's all active, then it's all just buying. It doesn't matter what the price of Apple is. The money comes into the account, you buy it. What happens if it starts to move the other way and there is no buyers? I'm right there with you. That's why I said it's kind of a double-edged sword. As long as everything's kind of moving okay, those passive flows every single month are going to continue to accelerate the multiples on those positions. I think honestly, regardless of what the fundamentals are telling us. So again, I don't need to bogart our time here. I was kind of curious if you guys were kind of thinking and interpreting, how that concentration is being driven overall from passive as it relates to the strategy on how you're allocating. So I appreciate the explanation. I think you did a good job on it.
Neil, did you have anything you wanted to add? I wanted to.
Yeah, no, just really quickly to Sean's point, I don't have the numbers in front of me, but I would be interested to look at those flows into passive from a retail versus an institutional perspective, just to see that breakdown.
Overall, it's about $24 billion a month just into the equity space. So 40% of that.
It's impressive.
Do you want to spend a few minutes on fixed income and then we'll kind of wrap it up?
Sure, happy to. In brief, yields rose for most of fixed income over the course of the quarter. I think inflation has proved to be a little bit sticky. We've come down to just under 3% by most measures, which is close to the Fed's target of 2-ish%, but it's been a little sticky. I think maybe of greater concern is what inflation could look like going forward. And there's so many economic policies and different things happening in the world with around tariffs and immigration and in budget deficits that markets just became a little more concerned about longer term inflation. And so rising yields caused much of the fixed income market to return negative returns in the quarter. And for the full year, most of the market produced a modest sort of single digit type return. The standout on the top of the page here is high yield bonds, the more economically sensitive corporate bonds. And with a remarkably resilient economy, those bonds have done quite well. And so our exposure to those has been a nice benefit within our fixed income fund. On the next chart, we're showing the path of Fed interest in the Fed funds interest rate. They cut it a full percentage point in 24, but given what we just talked about, the outlook is not for a series of cuts going forward, maybe one or two cuts over the course of 2025. And so when you look at yield curves on the next page, we had talked about the inverted yield curve for a couple of years there, and it's really been uninverting. If you look at that purplish line, that's where 2024 really started. And then that solid red line is where it ended. And so on the left-hand side, the very short-term rates came down in recognition of the Fed cutting rates by a full percentage point. And on the longer end, it actually rose a fair amount. And that's where those negative or weak returns on fixed income come from, is the longer term outlook for interest rates and inflation's got a little bit more bearish. And then, like we showed for equities, this is for fixed income markets. Year by year, fixed income usually turns in, a decent single-digit positive return. But pretty much every year, there's a period where it looks pretty ugly on a relative basis, not as volatile as equities for sure. But again, just the message is, be strategic and not reactive necessarily to what the market's doing. Here's inflation, the components of inflation. Obviously it had spiked after the pandemic, and it's still gradually coming down, but it seems like it's getting a little bit stuck here in the upper twos. And then finally, this sometimes referred to as the periodic table of asset classes. And I think you're familiar with this chart where basically the columns represent calendar years for the most part, and then those colored boxes represent different investment asset classes and their performance ranking for that year. And what you observe is what is the strongest one year can be one of the weakest the next year. If you try to chase markets, you can end up really destroying your long-term performance. A balanced portfolio is represented by those white boxes, tends to navigate pretty well through the middle, and has generally turned in pretty solid returns. And so that's the beauty of diversification and discipline in action. And I think that's about it. We included a slide from Neuberger. I know some investors like to see what the outlook is. We don't really do a lot of forecasting at Wespath, but we do rely on Neuberger for some of our assumptions. Neuberger Berman put this together, so we thought we'd just share it in here. I don't think there's anything in here for me to go into, though.
No. All right. Thanks, Frank. I know that when Frank and I and Neil went through, we talked about some of the contributors and detractors to the fund performance. You can see the US, we took the multiple asset fund off of this. I mean, we can continue to include it on here, just for your reference of how that fund did. But you can see here, how the month of December between the two US equity strategies, as Neil mentioned, it's really been a story of our active managers, relative to that benchmark, that Russell 3000 that we are measuring the fund against. And that's really been the main detractor, as well as our underweight to those mega cap names that have really been continuing to dominate the market. And that's been the main difference between the two US equity and index strategy. On the international equity strategy, this fund is about 85% actively managed, and it's fairly in line with the benchmark. We do at points have a modest overweight to emerging markets, which can be a contributor or detractor to the performance, just depending on how various markets perform. But primarily with international equity fund, because it is primarily actively managed, it's been an active manager story in terms of the differences between the fund performance and that benchmark. The two fixed income funds are at the bottom, and I'll just focus a little bit on the fixed income strategy. This fund's 100% actively managed, so we depend heavily on the issue selection from the underlying investment managers, which primarily is PIMCO. They manage a core plus strategy for us. This fund also has an overweight to high yield, underweight to US Treasuries, which, as Frank mentioned on the market slide, is our overweight to high yield has really benefited this fund's performance over the long term that you can see here when you look at the trailing performance. And for the quarter and month to date, it's been relatively in line. The main difference has been the fees, because we do report this net of fees, and the benchmark obviously does not have a provision for fees here. I do have some additional slides in the back that mainly talks about the impact for the quarter of, whether it's the market cap bias, small cap overweight, allocation to alternatives, and also the ethical exclusions, which again is not investing in alcohol, tobacco, gambling, adult entertainment, private prisons, and then the impact of our managers. I know we've shown you a few different slides like this every quarter. We're trying to make it more visually appealing to tell the story. So this is a little bit different than what we showed last quarter for this. But again, you can see the manager impact that it had, and it's primarily been the market cap bias, which impacted for the quarter for the US equity fund. Is there any questions?
Oh, it's Richard. I appreciate the new reports. I really think they help bring home what's going on. I'm just wondering too, I like the quarterly, but at the end of the year, would it be worthwhile to do the full year in this type of presentation?
Yeah, and we can add that. We do have those. We do have those slides. So what I can do is I can actually have Alicia add in the year-to-date slide, and then we can resend that if that works for you all. And so we'll do quarter and year-to-date, and it'll look like this.
Okay, yeah, or just year end's fine with me, but
okay,
yeah. Well, whatever you have, I think, rather than just quarter only, that helps.
Yeah, I like the
Happy
way you're
to
thinking
include that
there, Richard. We're always guiding investors to avoid short-termism, so I really like the way you're thinking. I mean, quarterly numbers are very noisy, and we don't want investors to think because we put something in front of you, then this is relevant, you should be concerned about it. So I appreciate that comment.
Is there any additional questions? My follow-up is to send the year-end slides, and we'll try to get those to you today.
Thank you. Thank you for your time and your expertise and your partnership and all the information you shared with us this morning. We really appreciate it.
Always a
Thank
pleasure.
you. We
Yeah.
appreciate the partnership too.